Purpose of financial markets and institutions. Financial markets are platforms where people trade financial securities, like stocks and bonds. Financial institutions are organizations like banks and insurance companies that provide financial services. Capital allocation. Moving funds from savers to borrowers. Risk management. Allowing investors to diversify or reduce risk. Liquidity. Enabling quick and easy buying or selling of assets. Financial markets and institutions support economic growth by channeling funds to productive investments, such as starting a business or funding government infrastructure. A tech startup issues shares through a stock exchange to raise capital for development. At the same time, a bank gives a small business loan to an entrepreneur opening a bakery. Both examples show how money is directed into economic activity. Monetary policy. Monetary policy is the process by which a country's central bank controls the money supply and interest rates to achieve macroeconomic goals like price stability, economic growth, and low unemployment. Expansionary policy used to stimulate economic growth. Example, lower interest rates. Contractionary policy used to reduce inflation. Example, raising interest rates. Monetary tools, interest rate setting, reserve requirements, and open market operations. Central banks use monetary policy to prevent inflation during boom periods and to stimulate demand during recessions. During the COVID-19 pandemic, many central banks lowered interest rates to encourage borrowing and investment, helping support businesses and workers during economic slowdown. Role and importance of central banks in the economy. A central bank is the national institution that manages a country's currency, money supply, and interest rates. It also oversees the banking system and works to maintain economic stability. Lender of last resort, providing funds to struggling banks to prevent collapse. Price stability, controlling inflation through monetary policy. Currency issuance, managing the supply of money in circulation. Central banks ensure that financial systems operate smoothly, step in during crises, and guide the economy toward long-term stability. The Bangko Sentral ng Pilipinas monitors inflation and adjusts interest rates to stabilize prices while promoting growth. In 2008, the U.S. Federal Reserve played a key role in responding to the global financial crisis by supporting banks and injecting liquidity into the economy. Importance of strong financial markets in every economy in enduring economic crises. A strong financial market is one that remains stable, liquid, and efficient even during economic stress. It ensures capital continues flowing and public confidence is maintained. Liquidity, access to cash or assets that can be quickly converted to cash. Investor confidence, belief that markets remain fair and transparent. Resilience, the ability to absorb shocks and recover quickly. Financial markets help governments and businesses survive economic downturns by allowing for continued investment, lending, and recovery efforts. During the 2008 financial crisis, countries with better regulated and more transparent financial systems, like Canada, were able to weather the storm more effectively. Similarly, during the pandemic, global stock markets acted as key tools for raising emergency funding through bond sales and equity offerings. In summary, financial systems are the engine that keeps the global economy running, from everyday banking to weathering crises. Understanding how they work helps us grasp the bigger picture behind economic decisions that impact our lives.